recording. Okay, so last time, I hope this thing is recording. Oh, who is doing this? Who is doing this? Who is writing on the screen? Who is writing on the screen? Who is writing on the screen? Oh, no, no. Who is writing on the screen? Who is writing on the screen? Okay, all right. So last time, our first lecture, we learned some things. We learned some things, and Telegram said there's network issue. Can you hear me? Telegram, can you hear me? Telegram, you can hear me, type 1. Telegram, if you can hear me, type 1. Telegram, if you can hear me, type 1. Okay, good. All right, let's proceed. Let's proceed. Okay. So last week, last meeting on Sunday, we started the training, and then we looked at what Forex is. I said Forex is the same thing as FX. We looked at the players in the Forex market, the government, the big banks, central banks, and all, the financial institutions, and then retail traders like you and I. We also looked at different currencies, and then assets, asset classes that we use in Forex. We mentioned the currency pair, we mentioned the commodities, we mentioned what else? Energy, we mentioned agriculture, we mentioned crypto, we mentioned bonds, several of them. And then, so I will advise that you go over the lesson again so that you can get abreast with what we did last time. So straight to what we have today, straight to what we have today. Straight to what we have today. Okay, just hold on a second. Hold on a second. Let me see if we can record this as well. Okay. Okay. All right. All right, let's begin. Okay, so today we are looking at trading the financial market. That's what we're looking at, trading the financial market. We're looking at trading the financial market. So let's look at that quickly. Now, under trading the financial markets, we'll look at trading sessions. Trading sessions. Now, today's lecture is very, very important, and it will be the last theoretical aspect of Forex before we get into practical from next class. So I need you to pay attention. If you don't have your book and a pen, please get a book and a pen. Let's begin. Okay, so trading sessions. We have 4 major sessions in our 24 hours clock cycle. Okay, so we have 4 trading sessions. Now, I did this in such a way that you will know the individual timing for Nigeria, all right? Because we are all in Nigeria. When you travel abroad, you can see how to adapt to their time. But for now, we're going to look at these trading sessions based on Nigerian time, okay? So we have the Sydney session. We have the Tokyo session. We have the London session. And then finally, we have the New York session. Now, in their various local times, the Sydney session starts 7 a.m. to 4 p.m. They are in their various local time, like the Sydney country time. You have there are some countries that are affiliated to this Sydney time. That's the Australia, the New Zealand, and other countries within that axis. Okay, so their starting time, the operation time, when Forex starts for them, their trading time is 7 a.m. to 4 p.m. And then we have the Tokyo session. The Tokyo session, their own local time starts from 9 a.m. to 6 p.m. They end 6 p.m. Then we have the London session. The London session starts 8 a.m. and ends 5 p.m. 8 a.m. and ends 5 p.m. And then lastly, we have the New York session. The New York session starts 8 a.m. in the morning and ends 5 p.m. in the evening. Now, for Nigerian time, Nigerian time, we have for the Sydney session, it starts 9 p.m. So 45 minutes from now, the Sydney session will start their own new day. So their new day will start 9 p.m. Nigerian time. That's when they're going to start their trading session, trading activities. Right now it's like 6 after 6, you know, 6 after 6 in the morning, 6:15 in the morning, their time. So by 7 a.m. their time, it will be at 9 p.m. So the Sydney session will start 9 p.m. and it will end 6 a.m. our time. That's tomorrow by 6 a.m. That's when the Sydney session will end. And then the Tokyo session will start 12 a.m. That's 12 midnight our time. And it's going to end 9 a.m. our time. That's tomorrow, Thursday. Then we have the London session that will start 7 a.m. our time, which is like same tomorrow, 7 a.m. tomorrow, and then it will end 4 p.m. So we and London, we share somewhat, our timing are somewhat alike. 1 hour difference, sometimes they're almost the same. I think right now they are the same thing, okay? But sometimes it's 1 hour apart, you know? So 7 a.m. our time to 4 p.m. our time, that is the London session. Then we have the New York session. The New York session starts this is supposed to be 1 p.m. Pardon me, this is supposed to be 1 p.m. Please take correction. It's 1 p.m., not 1 a.m. My mistake. This is supposed to be 1 p.m., not 1 a.m. So it's 1 p.m. our time. 1 p.m. our time, and it ends 10 p.m. our time. So by this time, by 10 p.m. Nigerian time, the New York session will close. Now, if you notice, there is an overlap. There's an overlap. Nigerian, for the Sydney session, Nigerian time, it starts 9 p.m. and ends 6 p.m. So as it starts 9 p.m., 3 hours after, the Tokyo session will start. So that's the overlap. And then by the time Tokyo session ends by 6 a.m., 7 a.m. Nigerian time, London session has started. And then by 9 a.m., Tokyo session will end. London session is still on. And then by 1 p.m. Nigerian time, New York session will start overlapping London session, because London session will close by 4 p.m. Nigerian time. So the New York session will overlap. So there's always overlap. So what it means is that there is a 24-hour cycle of trading. There's a 24-hour cycle. There is no time from Monday to Friday. It's a 24-hour cycle. Then by 9:59 p.m. on Friday, trading activities will stop till Sunday, 10 p.m. till Sunday. So you can trade on Monday, Tuesday, Wednesday, Thursday, Friday. Then trading activities stops at 9:59 p.m. on Friday, every Friday. Then it resumes Sunday, 10 p.m. It resumes Sunday, 10 p.m. That's when trading activities resume for Nigeria, Sunday, 10 p.m. So you need to understand, you know, the timing, all right? That Forex trading is 24 hours. It doesn't mean that weekends you trade. The only asset class that is traded over the weekend is crypto. That's the only asset class you can trade over the weekend, crypto. cryptocurrency, you can trade that over the weekend. So that is the typical example of 24 hours, 7 days a week. But for the other Forex asset classes, you don't trade them over the weekend. You only trade them Sunday night, 10 p.m. till Friday night, 9:59 p.m. That's when it stops, okay? So that's your trading window. I hope this is clear. If it's clear, you can type clear, type clear. Telegram and Zoom, type clear. If it's clear, type clear. If it's clear, type clear. Okay, good. Beautiful. Okay, Telegram, okay, beautiful. Okay, good. Zoom and Telegram, I've seen response from you. Okay, good. So let's go to the next one. So the next one we have, thank you. Let's go to the next one. We have currency pair description. Last time we learned about, Adam said not clear. When you listen to the recording again, I believe it's going to be clear. Okay. Last time we looked at currency pairs as one of the assets, okay? Financial asset classes, okay? It's one of the financial asset classes, currency pair. Now, I want to go deeper now into the whole thing. Now, for currency pair, because it's a pair, meaning that there are two currencies coming together, okay? Since there are two currencies coming together, we need to understand the dynamics. What do I mean by that? Now, for currency pair, the first currency is usually called the base currency. The next currency is called the quote currency. I'll take that again. Euro versus USD. Euro versus, please, when is market starting on Saturday? But I just said that market does not operate on Saturday, Nokia 7.1. I said market does not operate on Saturday. That it starts Sunday night, 10 p.m. and ends Friday night. There is no trading on Saturday, except cryptocurrency that is 24 hours. It does not stop. I said that now. You're still asking me this kind of question. You're not a baby now. Please, let's ask reasonable questions. Okay, let's continue. So, Euro versus USD. The Euro in this case is the base currency. And then the USD is the quote currency. So it is called base currency versus quote currency. I need you to understand this. Now, there's a way you can understand it better. The first currency in the pair is the base. The second currency is the quote. Now, the first currency is usually higher in value compared to the second currency. Now, in Nigeria, we know that dollar is obviously higher than naira. So if we want to have a forex pair combining naira and dollar, which one will come first? Obviously, dollar will come first. So we'll have USD NGN, because the symbol for Nigerian currency naira is NGN. So we'll have USD stroke NGN. So in this case, USD will be the base currency, NGN will be the quote currency, because you're going to use more of NGN to buy less of USD. So if you have $1, you're going to use, right now it's about 990 naira for $1, for 1 unit of dollar. You use 990 naira and above. I think today I looked at the exchange rates online and I saw that it's about 992, right? 992 naira to a dollar right now. You see why forex business is superb, because imagine if you make $1,000, convert it to naira, that's over 9 million naira. Sorry, that's over 900,000 naira. Then if you earn $10,000, over 9 million naira. So that's how the whole thing is. So let's come back to what we're talking about. So Euro USD, the Euro is the base currency, and then the USD is the quote currency. Let's go to the next one. Now, price quotes. Forex and currency pairs, any financial asset class makes use of prices, okay? So price quotes, how do you quote price? how do you quote price? We're looking at now the currency pair. Now, how do you quote price using currency pair? You're trading currency, how do you quote price? Now, if we say Euro USD is equal to 1.3432450, it means that 1 euro will give you 1.32450 dollar, meaning that euro is higher in value because you're going to use more of USD, more of dollar to buy euro, to buy 1 euro. So the pair, this pair, the price is related to the quote currency, because that's the quote. That's why it's called quote currency. So when you see price, when we start the practical, I think from our next class also we'll start the practical. When we start the practical now, and then you see prices, you will see how it is written. This is an example of how it is written. When it's written like this, it is for the USD, it's for the quote currency, meaning that the value of USD to euro is 1.32450. That's what it means. So you're going to use 1.32450 worth of dollar to buy only 1 unit of euro. I believe this is clear. If it's clear, type yes. If it's clear, type. If it's not clear, type no. I'll go back. I'll say it again. If it's clear, type yes. If it's not clear, type no. I'm saying this because this is very, very important. We need to understand this. If it's clear, type yes. If it's not clear, feel free to type no. I'll say it again. Okay. From the Zoom app, some people said no. Prince said no. Okay, I'm going to go over it again. Agnes said no on the Telegram app. Agnes said no. Okay, Joy said no. Okay, let's go over it again. Just one more time. Just one more time. Okay. Now, I'll say it again. Remember, I said that the first currency in the pair is called the base. The second currency in the pair is called the quote. All right, so you have the base currency and the quote currency. Please stop sending voice notes. We don't need it. Stop sending voice notes. It's not time for voice notes. Beauty, wellness. This is not time for voice notes. Please, thank you for deleting it. Okay, good. Let's proceed. So the euro is the base currency in this case, and then the USD is the quote currency. Now, what base, the literal meaning of base is whole, oneness, one. That's what base means, one, whole. So the base currency is the unit currency. 1 unit of euro will be sold or bought with the USD using this amount. So the price you're going to see on the chart for Euro USD is related to the quote currency, related to the dollar, not to the euro. The Euro USD chart, the price you will see at the right-hand side, like vertical. When we get to the practical, you will see what I mean. But let's just get the background knowledge first. The prices that are there are related to how much of USD that you will use to buy euro. So in this case, we have $1.3240 will be used to buy 1 euro. Is it clear now? If it's clear, I need your response now. Is it clear now? Is it clear now? Telegram, Zoom, respond. Okay, good. Beautiful, 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 beautiful. Okay, so let's proceed now. Thank you very much. So let's go to the next one. Thank you. Thank you. Now, the next thing we're going to look at is bid, ask, and spread. Bid, ask, and spread. Now, these are all Forex terminologies. You're learning Forex from the scratch. So you need to understand all these terminologies, because you can also be a Forex trader and then you don't know these terms. Imagine if you want to become a lawyer. Of course, you will learn what do you call it now? Law terminologies. Lawyers, they have big vocabularies they use. So these are the things you're going to learn. So as a Forex trader, you also learn some terminologies in Forex, so that when you talk to someone that is not a Forex trader, the person, this guy, true, they trade Forex, yeah. With senior mind, they trade Forex. Now, so I don't want a situation where you leave this training, after the training, after 2 weeks of training you, on the basis of Forex, you don't understand these little things. It's not going to be nice, okay? So I'm taking my time to explain so I can understand them. I'm bringing all the things that you need to know, the basic things you need to know in Forex. So what is bid? Because in Forex, we talk about bid, ask, and spread. So what are they? Now, bid, when we say bid price is the selling price. I want to sell euro with USD. So I'm bidding euro so that I can collect USD in return. And that's bid. So bid is the selling price. Ask is the buying price. I'll take it again. The bid, in trading, you have, for a trader that trades in any of the markets, okay, a market woman buys what they call the provisions, or foodstuffs, and then she sells. The amount she uses to buy that foodstuff is not the same amount she's going to use to sell it. So a plantain seller goes to the plantain plantation and buys plantain in bulk. Maybe one bunch of plantain could be sold for, let's say, 5,000 naira, hypothetically 5,000 naira. And then she buys it from them at 5,000 naira. She obviously cannot sell it to someone else in the market at 5,000 naira. She's going to sell it higher. So the bid price in this case now is 5,000 naira. The ask price will be something higher. So something like maybe 5,500 or 6,000 naira. So the bid price is 5,000. The ask price is 6,000. So that should make you understand this. Now, the difference between bid and ask is called spread. To the market woman that sells plantain, she buys at 5,000. She sells at 6,000. The difference between her buying, what they call it, cost price, which is the buying price, and the selling price she sells to people is called profit in her case, in the general, what they call it, the general understanding of business. That's profit. What you've made is profit. But in Forex, it's called spread. So the difference between the bid and the ask is called the spread. Now, the spread is determined by what they call it, the platform, your trading platform. In this case, in Forex, we call them brokers. They are brokers. They give us access to the financial markets. So they are the gateway through which you can trade all these financial instruments. So they determine the spread. That's the difference between how much they bought the what they call it now, the currencies or the financial instrument, and how much they're willing to sell to us, because we are not the owners of the market. They also are not the owners. They're like wholesalers. They collect from the main people and then they give to us. So that's how it operates. So the spread is determined by the brokers in this case. So just understand that bid is called selling price, and ask price is called buying price. And then the difference is called spread. If I have made myself clear and you understood, type understood. I'm waiting, understood. Telegram, Zoom, buzz me. If you understand, type understood. I'm waiting. Telegram, Zoom, you're too slow. I'm not seeing responses from Zoom. Zoom, you're slow. I'm not seeing responses from Zoom. Understood. Okay, yes. Ukoma says understood. Yes, Prince said understood. Beautiful. Telegram, a lot of, yes, thank you. Abel understood. Simi understood. Dr. Thomas understood. Beautiful. One person understood. Amit understood. Thank you very much. Bayo understood. Okay, so let's go to the next thing. Thank you. Let's go to the next thing. So the next thing is PEEP. I believe you've heard of the word PEEP. It's a Forex term, okay? PEEP. PEEP is a forex term, right? So the question is, what is PEEP? PEEP, please pay attention. If your children are distracting you, or your girlfriend, your boyfriend, your husband, your wife, your colleague, whoever is around you at this moment, please detach yourself from the person and pay attention to this. This is very important. This is very important. Please, I beg you, detach yourself from anybody that is going to distract you and pay attention to this. PIP. PEEP. What is PEEP? PEEP stands for percentage in points. PEEP stands for percentage in points. Now, what does it mean? What does it mean in general? Because this is like definition now. So what does it mean? What does it mean? Now, PEEP is actually 1% of 1% of price. I'll take that again. I know you don't understand it now, but you understand it later. Just wait and listen. PEEP is actually 1% of 1% of price. Now, why is that so? Each movement of price is called points. And for Forex, it is in 10 units. It's in 10 units. So, so 1 unit, one unit movement of price, which is points, okay, is one unit is 1 point. So 10 units will now form what we call PEEP, because it is the percentage, 1% of 1% of price. Now let me go back to, let me use this example so they can understand. Let me explain it. Now, if for Euro USD, if Euro USD is equal to 1.3450, 4510, 1% of this price, 1%, that's, you know what 1% is now? If you divide this price now by 100, you get 1%. So 1% of this is 0.01. Now, that's if you're dividing 1 by 100, please, mathematicians, or just take your calculator. If you divide 1 by 100, you're going to get 0.01. If you divide 1 by 10, you're going to get 0.1. So 0.1, that's 1 over 100, the same as 0.1. Then 1 over 100, sorry, 1 over 10 rather, sorry. 1 over 10 is the same thing as 0.1. Then 1 over 100 is the same thing as 0.01, which means 1 over 1,000 will be 0.001. Good. So 1% of price, no matter the price, 1% of a price is 0.01 value. Then 1% of 1%, meaning 1% of 0.01. Remember, we started by saying 1%. I can't hear any voice. Please, the audio recording. If you can hear me, someone is saying they cannot hear me. If you can hear me from Telegram, type 1. If you can hear me from Telegram, type 1. If you can hear me from Telegram, type 1. Okay, good. That means I'm loud and clear. Okay, good. Okay, beautiful. Okay, let's proceed. Thank you. I appreciate your responses. Thank you. Let's continue. So 1% of price, let's say that the price is 1. Okay, 1% of 1 is 1 over 100. So if you use your calculator to divide 1 by 100, you're going to get 0.01. So remember, we said that PEEP means percentage in points, which is 1% of 1% of price. So if 1% of the price is 0.01, then 1% of the 1% of the price will now be 0.0001. So you're like dividing 0.01 by another 100. You're going to get 0.0001. Good. Now, what does this mean? It means that if Euro USD moves by 0.0001 from 1.34501 to 1.34510 to 1.34510, 20, you have gotten 1 pip percentage in points. So remember, we have 0.0001. This first zero there represents this one here, right? Represent this one here. This point is the point we have here. Then this 0 is this 3. The next 0 at the middle is this 4. The third 0 is this 5. Then this 1 here is this 1 here as well. This other 0 is insignificant. I'm going to tell you what that 0 means. But for now, we are using 4 decimal places. When we say 4 decimal places, mathematically, we are saying if you move your decimal points from here, where it is now, this is 1 decimal place, 2, 3, and 4. So this is 4. So 4 numbers after the decimal, like to the right, 4 numbers after the decimal. That's why it's called 4 decimal places. So if you have another number after 1, it will now be 5 decimal places. So in this case, it's 4 decimal places. So in Forex, especially major pairs, you're going to make use of 4 decimal places for 1 pip. So this 3451, that's the figure you're looking for. So if the price you bought Euro USD at 3451 and it moves higher to 3452, what has happened is that it has moved 1 pip. It has moved 1 pip. I'll take it again for the last time so you can get it clear. Now, if you buy Euro USD and you bought it at 1.3451, disregard this last figure, okay, this last 0, disregard it. We're making use of 4 decimal places now, okay, we're looking at pips. So it then moved from 1.3451 to 1.3452. It means that this thing has moved by 1 pip. It has moved by 1 pip. Now, supposing the price that you saw it was at 1.3451 and it then reduced to 1.3450. It means that it has moved lower by 1 pip as well. Is it clear? If it's clear, type clear, 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 clear. If it's clear, type clear. If it's not clear, type unclear, unclear, unclear. If it's not clear, type unclear. If it's clear, type clear, 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 clear. Beautiful, beautiful, beautiful. Thank you. Zoom and Telegram. Thank you, thank you, thank you. Okay, good. Someone said, Nehemiah said unclear. Maybe you are not paying attention. You are not paying attention. I'll just take it one more time and then we'll go to the next thing. Okay. Pip, the 4th digit. The 4th digit. Amisco said unclear as well. So pay attention now. Pay attention now. I want to explain. The 4th digit, the 4th number, the 4th figure after the decimal points. After the decimal point, the 4th number, this is 1, 2, 3, 4. Good. The 4th number after the decimal points is what determines pip. Percentage in points. That's what determines pip. So if it moves up or down, it increases up or it reduces lower, it means that the pip value has changed. So if this one here now, 3451, moves to 3452, that means it has moved by 1 pip. If it reduces, if it goes 3450, it means that's reduced by 1 pip. So if it goes lower than 1, it will reduce the pip. If it goes higher than 1, it will increase the pip. Is it clear now? Those of you that said unclear, Amisco, you said unclear. Nehemiah, you said unclear. Those of you that said unclear, if it's clear now, type clear. If it's clear now, type clear. Makistari said unclear. If it's clear now, type clear. Okay, yes, okay, good. Makistari, I'm waiting for you. Makistari, I'm waiting for you. Nehemiah on Zoom, I'm waiting for you. Beautiful. Okay, good. Makistari, I'm waiting for you. You say no clear. I don't explain now. Better. All right, good. Let's go to the next one. Let's go to the next one. Okay, we are making progress. Now let me ask a smart question. Let me see if those of you that are smart now. Okay, assuming Euro USD price, pay attention, oh, pay attention. Assuming Euro USD price moves from 1.3451, which is what it is now, to 1.3461. I'll take it again. Assuming Euro USD price moves from 1.3451 to 1.3461, how many pips has it moved? How many pips has it moved? Okay, Mike has answered. I'm not going to mention what he said. I need answers from other people. Mike may be wrong. Matthew may be wrong. Uchechi may be wrong. Shalom said 1 pip. Ah, okay. Now 9 pips. Keep coming. Agnes said 6 pips. Okay. Oh. Okay. Uche said 10 pips. And no 80 said 11 pips. Okay. Eunice said 2 pips. Away. Okay. All right. Thank you very much. One person said 5 pips. Let me explain again. Okay. All right. That's enough. Let me explain again. Thank you for your responses. Some they said 2 pips. Okay. Thank you. Let's continue. This one said no pips. Now, wow. All right. Now, look at it. Look at it very well. If Euro USD, if Euro USD price moves from 1.3451 to 1.3461, it means it has moved by 10 pips. It means it has moved by 10 pips. Those of you that said 10 pips, you are absolutely correct. How do you get it? Remember, if it moves from 1.3451 to 1.3452, that's 1 pips. 1.3453, 2 pips. Like that. How do you know? Now I said 1.3451 to 1.3461. So what is changing is just these 2 figures at the middle, the third decimal place and the fourth decimal place. Okay, so you take those numbers and minus it from the 1 that was given before, you get 10. So 1.3461. If you minus it from 1.3451, you're going to get 0.0010. That's 10. You're going to get 10. So it's like saying 61 minus 51. You're going to get 10. That's how you get. That's how we got 10. All right. So we moved from 1.3451 to 1.3461. It has moved by 10 pips upward. Now, the next question, before we go to the next thing, the next question is this. If it moves from 1.3451 to 1.3443, pay attention. It moved from 1.3451 to 1.3443. 1.3443. It moved from 1.3451 and then it came to 1.3443. How many pips has it moved? And did it move upward or downward? So you're going to write it. How many pips did it move? Is it? Then you write, if it's 2 pips, you say 2 pips upward or you say 2 pips downward. That's what I want to see. Or your responses from you. Telegram, Zoom. Quickly. I'll take it again. 1.3451 to 1.3443. How many pips did it move? Quickly. And then, is it upward or downward? Zoom, you guys are dulling me. Only one person has responded. Okay, I'm seeing responses now. Okay. Beautiful. I like the responses. We are all following. Okay, good. So let me give you the final answer. All right, let me give you the answer. So what you're going to do is this. You take your calculator. Remember the figures that have changed now. You have 1.3451 and then change to 1.3443. That means what changes just 51 to 40. So you're going to say 51 minus 43. And the answer is 8 pips. 8 pips downward. So it moved 8 pips downward. That's what it did. It moved 8 pips. So those of you that wrote 8 pips, you're doing well. Thank you very much. So let's go to the next one. We'll spend much time on this. So let's go to the next thing now, quickly. Okay. I'm trying to see how to wrap up this thing in less than 2 hours. I don't want us to stay till 10. Okay, let's go to the next one now. So the next thing is, how do you make profits? So now that we've learned how to calculate pips, okay, lest I forget, thank you, lest I forget, the last digit is then called what? Remember, there are 5 digits after the decimal point, but we're making use of only 4 for pips. So the last digit is called what is called pipette. It's called pipette or called points. So 10 points will give you 1 pip, 20 points, 2 pips. So this 1.34510. This last 2 digits is what you use for your points and pips. So this is 10 points, 1 pip. If it moves from 1.34520, that will be 20 points, which is what? 20 pips. So another name for that last digit is called pipette or point. Pipette or point. Pipette or point. So that is it. I believe that is taken. Let's go to the next one now. So how do you make profits? How do you make profits? Now let's take, for example, for buy scenario. Now, in Forex lingo, in Forex, what do you call it now? Vocabularies, okay? One of the terms used is bull and bear. The bull animal is what you have here as buy. So the bull animal represents buy. Why? Because when it wants to attack its predator or prey, it takes its horn down and raises the enemy up. So, you know, like bull, takes it down, it takes the horn down, and then it raises the enemy up. That's why it's called, that's when price goes up, it's buying. So the bull always lifts someone up or lifts the enemy up. That's why they use the bull as a symbol for buy. Then the bear always takes down. Your head will be up, then when it wants to attack, it will take it down. So that's why it's called, it's used as a symbol to represent sell. So when price is going down, it is selling. And when price is going up, it is buying. So bull for bear, sorry, bull for buy, then bear for what? Sell. So when we say a bullish market, pay attention. No, I told you that today's lesson is very, very important and crucial. When we say bullish market, we are saying a market that is going up, a market that is buying. The price is rising, it's going up. So it's going, it's a bullish market. It's a rising market, it's an increasing market, it's going up, upward market. Then when we say bearish market, bear market, it means that price is going down. It means that price is selling. The market is selling, that asset is selling. Please pay attention and take note of this. Don't go and disgrace me outside. Ha. Don't go and disgrace. Thank God there's recording to this effect. I learned one Forex from one man, and he told me that bear is sell, is buy. Now my hand from sky will just come slap you. So please pay attention. Bear is for sell. Bull is for buy. Don't go and disgrace me. Okay, thank you very much. Okay, so let's proceed. Now, how do you make profit? Now, one interesting thing about Forex that I tell my students is that Forex, you don't care whether bull is not sell or bull is buy or Eunice. You see, whenever I won't finish class, Eunice don't deform my hand. Eunice, bull is buy. Eunice, she has deleted it. Okay, all right, so let's continue. So Eunice, bull is buy, bear is sell. Thank you very much. Okay, so let's continue. So I like to tell my students that in Forex business, you don't care whether price is going up or price is going down. In fact, there is no law for any particular assets or pair because you're there to make money. It's not like I don't want Euro USD to go up because if it goes up, I will lose. No. If it's going up, you buy it. If it's going down, you sell it. Simple. Now, you can make money while buying. You can also make money while also selling. There is no preferential treatment. Not say, no, if this, like, for instance, there are some asset classes, like if for crypto now, okay? Crypto, if crypto coin that you buy, maybe any of the coins, you buy it, you bought it when it was very cheap. and then the price went up. That means, let's say you bought a particular coin, maybe Bitcoin, when Bitcoin was around $200 for one Bitcoin. When price will rise, and then you bought, let's say you bought $1,000 worth of Bitcoin, which means you bought 5 Bitcoins. Now, when the price rises from 200 to 2,000, it means that your 1,000 that you the value of it has risen from, what do you call it, 1,000. It has risen to 5,000. So you made more profits. As if I thought, sorry, 10,000 rather, not 5,000, 10,000. So when the price of Bitcoin is going up, you will be happy because the value of your coin, the value of the coins you bought will also go up. Then when price of Bitcoin goes down, the value of your coin will also go down. Not the number of your coins, the value of your coin will go down. Meaning that, let's say you bought one Bitcoin for $200, and then Bitcoin then went down to $100. That means you have lost 50% of the value of what you used to buy your Bitcoin. So at that point, you'll be praying that Bitcoin should rise so that you can make profit, or you can go to break even. We'll talk about break even later. Okay. But for Forex, apart from crypto, every other asset class, as the price is going up, you buy. If it's going down, you sell, and you're good to go. It's only crypto coins, cryptocurrency that when you buy coins, the price, as the price goes up, you're making money. When the price goes down, your money, depletes, you lose money. That's just the difference. Okay. So let's understand that. So for Forex, it's not the same. It's not, these are other classes, other asset classes. It's not the same, apart from what crypto. Please take note. So now let's come back to what we're doing. Now, so how do you make profit? Now, let's assume that you bought USD at 1.34510. This is your entry price. You bought it at this price. And then price moved to 1.34710. If you minus 551 from 71, remember you bought it here, and price then went up. It has increased. It has gone up from 5 to what? 7. So you move from here to this. So 51, if you minus it from 71, you're going to get 20. So 20 pips or 200 points or 200 pipettes. Remember, we talked about pipettes and points. So once you move by 20 pips, you have made profit of 20 pips. Okay. Now the 20 pips profits can now be converted to dollar based on what the other things I'm going to teach you later, but just understand how profits are made. So if you bought it at this price, if you bought it at this price, you bought, and then it went down. It then went down. Instead of going up, it then went down by 10 pips to 1.34410. So 5141, that's 10. Difference is 10. That's 10 pips. It then went, you bought it to, but now as you bought it, instead of price to go up, price started coming down. If it goes down by 10 pips, you'll be at a loss. Why will you be at a loss? Because you bought when you're supposed to sell. You bought and price started selling. So in that case, you will be at a loss. But if you knew that price will sell, and then you sold it at this price, and price went down, it means that you'll be in profit. Let me explain again. Please pay attention. In Forex, one of the things that you will learn as a Forex trader is to be able to know when price of an asset will go up and when price of an asset will go down. The reason for this is because you want to know, if you know when it will go up and you buy it, then you will be in profit as it keeps going up. You'll be making profit. But if you felt it to go up, then you bought it and price starts going down, now you go lose tire. You go lose tire. So that is how it is. So you will lose money. So that's it. So your understanding of when price will go up and when price will go down determines the profit you're going to make. And that makes you a Forex trader. So please pay attention. Now, what do you mean by stop loss? We understood profits. Let's say you bought it here. and it went up by 20 pips, you can take profit at that 20 pips or allow it to go further up. Now, what is this stop loss? Let's assume now that, okay, I have looked at this gold. I feel that gold is going to go up. Okay. Now, it's going to go up from, let's say, the current price of gold is maybe, let's say, 3,000 some or 4,000 some, depending on what it is now. Like I don't know the current price of gold right now, so I need to look at my chart. Let's say it's 3,000, okay, per ounce of gold now, $3,000 per ounce of gold. Now, you feel that price is going to go up, and then you say, okay, let me buy this gold because it's going to go up. So if it goes up, I'll be in profit. The moment you bought it, unfortunately, your village people followed you, and then price started going down. As it starts going down, because you have placed buy, and this started selling, you'll be at loss. But there's a way you can protect your losses so that it doesn't go too much. You don't lose too much. You make use of what we call stop loss. So stop loss is the instrument, is the mechanism that Forex traders use to limit their losses whilst trading, because they are must, M-U-S-T, must, in capital letter. You bold it, italize it, do anything just to make it more emphatic that you must lose as a trader. There is no way you can trade, you can be a trader without incurring losses. You must lose. That's the simple truth. Any Forex trader that tells you that he will not lose, that Forex trader is just deceiving you. So every Forex trader loses at some point, okay? So what we do to limit our losses is by using stop loss order. So I am saying that now, for instance, I want to buy this Euro USD now on the screen, and my entry point is 1.34510. That's the price. And then price started going down as I placed the order for a buy. Right? I will tell myself, say, now that I want to buy this thing, should this thing move against me? What is the against now? I want to buy it. Should it now sell? How long can I absorb the selling? And how much am I willing to part ways to the market and say, okay, if this thing goes against me, market, take only so amount from me. Don't take more than this amount. So I'm going to say, okay, I want to buy this thing. Okay, I'm willing to risk $100 of my money. So I put a stop loss order of $100. So, okay, I want to risk $100. If it goes against me, I will only lose $100. Let's say I have $10,000 or $100,000, okay, as my trading capital. And then I enter this trade to buy Euro USD. I'll tell myself, I say, okay, if I place this trade for a buy, if this thing goes against me, please, markets, take only $100. Don't take more than that. So I'll calculate it and make sure that my stop loss order, I will instruct the market that, look, if this thing sells, if it sells to this point, not take me out of the market. Let me only lose $100. I don't want to lose all my capital. I want to only lose $100. So at every point in time, you have to tell yourself how much you're willing to lose before you place any trade. How much are you willing to lose? When you've understood, or when you've come to the reality of how much you want to lose, then you then calculate it. I'm going to tell us how to do all the calculations later, okay? But let's just understand how profits are made. Losses are also incurred. So you put your order and say, okay, if it goes against me, take $100 off my account. Then let me lose only $100. So if I have a $10,000 account and I lose $100, that means my balance will now be $9,900. $100 gone because I have what I did, it went against me. But if it should go in my favor and it goes up to this level, because if 10 pips, if it goes against me by 10 pips, if I lose $100 by 10 pips, it means that if it goes in my favor 20 pips, I'm going to get $200. So if it goes in my favor, I buy it, I bought it here, and it didn't sell to take me out. It rather went up to 20 pips. It means I have gained $200 that day for that trade. I'm now in profit. That means my capital will now rise from 10,000 to 10,200. The same thing applies to when you're selling. So when you're selling, you want market to go down. In a bear market, you want it to go down. So if you want price to go down, and then you put your entry price at the 0.51420, your stop loss will be above. Why? Because you want to sell it. So, but if price should reverse from here and starts going up, if it goes up by 10 pips, it will knock you out because your stop loss order is 10 pips. It doesn't mean that you must always put 10 pips order. You can put 100 pips, 1,000 pips, 5 pips, 2 pips, 3 pips, 20 pips, as the case may be, depending on what you want and how much you're willing to risk to lose. So if you are selling, your stop loss order must be above your entry. Then if you're buying, your stop loss order must be below your entry. So I want to buy, stop loss order is below. I want to sell, stop loss order is above. So take note. So as I'm selling, my stop loss order will be above, telling the market that if it goes against me by 10 pips, I should be out of the market and I'll lose social amount of money. But if it goes in my favor and I get to my target points where I want price to get to, and it got to that point, I'll be making profit. So that is how it is. Yes, I'm on Bull. They have not changed the screen, so we are still there. Akindele, we are still there. On the Telegram app, we are still there. Okay, so that is explanation. So take note. If you buy an asset, your stop loss will be low. Your take profit will be above. If you sell an asset, your stop loss order will be above and your take profit order will be what? Below. That's how it works. Let's go to the next one. I believe this is clear. This is it clear? It should be clear, right? Please, if it's clear, type yes. If it's clear, type yes. Blessing said no. Whoa. Hey. Who else again? If it's clear, type yes. If it's not clear, type no. Blessing on Telegram said no. The rest of it said yes. Daniel said yes. Simi said yes. Samitech said yes. Thank you very much. Shalom said yes. Zoom, what is going on? Nobody said. Udo, thank you. You're the only one responding actively every now and then. Thank you, Udo. Uche, thank you. Apoveri said no. Okay, let me explain one more time. Just get it now. Thank you. Everyone, thank you. Stop responding. Now, when you want to buy, remember this is a business and it's trading. What is trading? The act of buying and selling. That is trading. If you remember on Sunday, I told us that before the advent of computer and internet that surfaced in the, especially the internet that surfaced in the early 90s, before then, or late 90s rather, before then, that Forex was traded in the open floor, like physically. You go to the trading pit and then you trade, you buy and you sell. But it's not done like that now. Everything is programmed and you go through a channel called a broker, a gateway. So it's different now. So it is still the same buy and sell. So the question is, how do you buy and how do you sell? And I've told us that buying is when price goes up. When you see the price going up, that means it's buying. Selling is when price goes down. When price is going down, it's selling. And I told you that you can make profit both ways. You can make profit when price is going up. You can also make profit when price is going down. But it depends on the order that you take. So if, let me concentrate. These comments are funny. Let me concentrate. So if you take an order, I say, I want to buy this asset. You place an order and then price starts going down. Remember, you placed an order for a buy and price starts going down. It means that you are losing. But if you place an order for a buy and price respected your order and starts going up, you are in profit. You'll be making profit. Now, you don't want to risk, you don't want to put your account at risk by just placing a buy without without placing an order to limit your losses in case it goes against you. So if you place a buy order put another order or put another mechanism that will make you reduce your losses. And that mechanism is called stop loss. Stop the losses. That's what it means. Stop the losses. Stop the loss. Now, I placed a buy on this asset and it's going up. And then after a while, as it just went up a little, it started going down. Maybe it goes below my entry, I'll be losing. So what do? I have to say stop the loss. I have to put an order to stop the loss, a mechanism to stop the loss. That is what we call stop loss. So as I lose to this point, if I lose to this point, stop the losing. I don't want to lose more than this point. That's what it means. I don't want to lose more than this point. I want to lose up to this point and stop. So I'm willing to lose so amount of money. After this, I'm not losing again. So once you instruct the market or the app, your trading app, I'm going to teach you all those things, how to place stop loss and take profit. So once you instruct the app will then obey your instruction. When it gets to that, once the price goes against to that point, it will take you out of the market. And you only lose that amount you have told the app that you want to lose. That's it now. I think it's clear now. Then if you're selling an asset, you place a sell order and price starts going against you, price starts buying. Remember you said you want to sell this thing. Unfortunately, that time you place sell, price started buying. Once price starts going up, you will be losing. So how do you limit your losses? You place a stop loss order saying that stop the losses. I don't want to lose beyond this. So once you put stop loss, as it buys up to your stop loss order, it will hit it and then take you out of the market, and you lose just a little than losing your entire money. Is it clear? Now, those of you that wrote it was not clear. So just know that if you buy, your stop loss will be below your entry. If you sell, your stop loss will be above your entry. If it's clear now, type yes, it is clear. Yes, yes. For those of you that said it was not clear, I need you to respond now that it is clear. For those of you that said it was not clear, Purity said it was not clear. Is it clear now? Uchechi said it was not clear. Is it clear now? Those of you that said it was not clear, type now. I want to see you typing that it is clear. Those of you that said it was not clear, I want to see you typing that it is clear. Okay, thank you very much. Purity, thank you. Paulo, thank you. Who else again? Adriano, thank you. You're doing well, doing well, doing well. Okay, good. For Lashade, thank you. Okay, let's proceed. Let's proceed to the next one. To the next thing. So the next term you need to understand in forex trading is called lot size. Lot size. That's another thing you need to understand. Now, a lot of traders have issues with lot size. Okay, they don't understand lot. Now, lot is the same thing as volume. I want to buy Euro USD. Is it 1 unit of Euro USD I want to buy, or 2 units, or 3 units, or 4 units? That is determined by a lot size. So I want to buy this Euro USD, and I want to buy 10 lots. I want to buy only one. I want to buy 1,000. I want to buy 100,000 units of it. That is determined by lot size. So lot size is the same thing as volume. What volume of this thing do I want to buy? Bag of rice, I want to buy 10 bags of rice. That's the volume. I want to buy just one bucket or one custard rubber or just one cup. Those are volumes, okay? So in forex as well, we have what we call volume. And that volume is determined by what we call lot size, okay? These are I'm just telling you the terms. I'm not telling you how to use them now. When we start the practical, you understand how to use them. I'm just telling you what they are theoretically, and then explain it to you so they can understand. And maybe you'll probably explain to someone else. So lot size is another thing, another term that is used in forex. Now, pay attention. One lot in forex trading, especially currency pair, one lot is 100,000 units of a currency pair. One lot is 100,000 units of a currency. So if I'm using one lot, I'm saying that I'm buying 100,000 units of that currency. If I use 10 lots, then I'm using 1 million units. I'm buying 1 million units. If I use 0.1 lots, that means I'm buying 10,000 units. Then if I use 0.01 lot, I'm buying 1,000 units. Now remember, okay, not sorry to say remember, because you don't know it, so I've not said it before. The least amount of units you can buy from any buy any currency pair is 1,000. The least amount of units, not $1,000. It's 1,000 units of that asset, of that currency pair. So we're making use of Euro USD. Now for Euro USD, you can only buy, the minimum unit you can buy is 1,000 units. And that is determined by 0.01 lot. That is the lowest lot size you can use in Forex. You cannot use 0.001. The lowest you can use is 0.01, meaning that the lowest units you can buy any currency pair is 1,000 units. Please take note. So once you place a trade and your lot size is 0.01, just know that you are buying or you are selling 1,000 units of that asset or that currency pair that you are trading. 1,000 units. Always know that you're using 1,000 units, you're buying 1,000 or selling 1,000 units. Now, if you buy 1,000 units, what will be your profits in dollar or in naira or monetary value? What will be your money? What will be the monetary value if it moves by 1 pip? Remember pip now. Remember pip, percentage in points. 1% of 1% of the price. Remember, good. So if you use 0.01 lots, it means you have bought 1,000 units of the asset. And then if that asset moves by 1 pip, either buy or sell, you will make 0.1 dollar profit, which is like 1 cent. All right, $0.1 is same as 1 cent. So you make only 1 cent. Okay. If it moves 10 pips, 10 times 1, that will be 10 cents. Okay. So any pip it moves, as long as your lot size is 0.01, you're only making $1 per pip per movement into one. So 1 unit will be 0.01 cents. So the one point will be 0.01 cent. So 10 points will now be one pip, which will now be 1 cents. Okay, I believe you understand. 0.1 cent. Let me explain again. You are buying the least amount of what they call currency pair that you will buy in trading is 1,000. You cannot buy or sell less than 1,000. 1,000 is the minimum. It's like saying, okay, I want to be part of a Garri Sellers Association. And they tell you that, look, for you to join us, the minimum bags of Garri you can be buying is 1,000 bags. If you know you don't have the money to buy 1,000 bags, don't join us. So anytime you place a trade, anytime you want to buy Garri, whether you have money or not, if the minimum you can buy has to be 1,000 bags. So that let's understand that. So in trading, the minimum you can buy any asset, especially currency pair now in particular, because we're dealing currency pair now, it is 1,000 units of that currency pair, whether Euro USD, GBP USD, USD JPY, all the USD, all the currency pairs will land on Sunday. If you want to buy them, the minimum you can purchase at a time is 1,000 units of those currencies. And the volume that 1,000 represents is 0.01 volume, which is the loss. Okay. Now, if that's once you buy or you sell and the thing starts moving in your favor, if it moves by 1 pip, remember I've talked about pip before we came to this one. Now, if it moves by 1 pip, you will make 1 cent. That's $0.1. $0.1 is same as 1 cent, right? No, 10 cents. Thank you. 10 cents. It's 10 cents because 100 cents will give you $1. So 0.1 is the same thing as 10 cents. Thank you. It's 10 cents, not what do you call it? Not 1 cent. It's 10 cents. 10 cents. Okay, so the next thing is if you buy 10,000 units, you're going to use 0.1 lot to represent 10,000 units because you cannot write 10,000 units. You're going to write it in the volume that you're willing to buy or sell. So you write 0.1 lot. Once they see 0.1 lot, they know you're buying or selling 10,000 units. Now, if it moves in your favor, each pip that it moves in your favor, each pip is $1. So if it moves 10 pips, that's $10. If it moves 20 pips, that's $20. If it moves 30 pips, that's $30. Okay? Now, if you buy 100,000 units, that's one lot size, one lot. You place one lot, it means they're giving you 100,000. You're trading 100,000 units of that currency. So if it moves in profit by 1 pip, that will give you $10. 2 pips, $20. 30 pips, $30. 10 pips, $100. 100 pips, $1,000, like that. Okay? Then if you use 10 lot size, which is 1 million units, if it goes one pip, just 1 pip, using 10 lot size, you're going to make $100. 2 pips, $200. 10 pips, $1,000. 100 pips, $10,000. All right? So that's how it goes. The more your lot size, the more your profit or your loss. So if you increase your lot size and you think the trade goes against you, you lose more. If you reduce your lot size, the trade goes against you, you lose less. If you increase your lot size, the trade goes in your favor, you make more profit. If you reduce your lot size and the trade goes in your favor, you make less profit. I hope this is clear. I hope this is clear. So lot size talks about volume of the currency pair you want. What quantity? That's what it means. What quantity? So I talked about the volume, the notional value, and then the profit per pip. I hope this is clear. If it's clear, type yes. If it's clear, type yes. If it's clear, type yes. Let's go to the next one. We have 39 more minutes to wrap up this class. I have a lot to do. I have a lot to do. I may not repeat this thing again, please. All right, for time's sake. Let's go to the next one. So next one. All right, thank you. Profit or losses. Profit or loss. Now, like I said before, if you sell 100 assets for 200,000 naira, $200,000, all right? Pay attention. If you sell 100 assets for $200,000, what it means is that one asset is $2,000. One asset is $2,000. 100 assets, 200,000. One asset, 2,000. Is that clear? One asset. If you sell 100 assets for 200,000, it means that you're selling one asset for $2,000. Okay. Now, if your profit is $100,000, it means that if you minus 200 from 100, you're going to get your profit. Now, let me explain again so you can understand. Just as we said before, if price is going higher, you're making profits, especially when you buy. If price is going lower, when you bought it, you'll be losing. So one asset is 1,000 naira, for instance, $1,000, for instance. If the one asset moves, if it moves by maybe 10 points or 100 points, as the case may be, you will make an additional 1,000. So just understand that when price is going up, you're making money. When price is going down, you're losing, especially when you bought it. But if you sold it and price starts going down, you'll be gaining, you're making profit. If you sold it and price starts going up, you'll be what? Losing. So that is how it is. That's how it is. So the same thing applies here. The price sells, you make profit. Price, if you sell the price, sell the asset and it goes down, you make profit. If you sell it and it goes up, you lose. Okay? So that's how it is. I've talked about take profit and all that. I think this is repeating. I'm repeating the slide. Okay, so how do you calculate your profit? Manually, how do you calculate profit manually? For example, let's say GBP USD. Okay, before we proceed, just in 1 minute or 30 seconds, what is the nickname for GBP USD? Quickly, Telegram, Zoom, reply, type. What is the nickname for GBP USD? I want to see those people that were in class on Sunday and went through the recording. If you went through the recording and you were in class, you paid attention, you will know what I'm talking about. What is the nickname for GBP USD? Okay. I need response from Zoom. No one is saying anything. Zoom. Telegram, only 2 persons. Only 2 persons. Hey. Paulo and Samitek. Abel, thank you. Okay, good. Okay, the answer is cable. Samitek, you were wrong. The answer is cable, not fiber. The answer is cable. So thank you very much. Let's concentrate now. Let's continue. So example, if cable price is 1.52031, it means that 1 GBP is equal to 1.52031 USD. That's what it means. That is what it means. So I'm buying, like I explained, I'm buying 1 GBP with 1.52031 USD. Now, using one lot, if you go back to what we did before, one lot is equal to 100,000 notional value. So let's come back. Just show you this so you can understand. So one lot, using one lot, 100,000 notional value of this. If you multiply 100,000 by this, you're going to get this. Remember, 1 unit of GBP is equal to 1.52031 of USD. Remember, cable is a currency pair combining the base currency GBP and the code currency USD. And I told us that the code currency is what the price signifies. The base currency just shows 1. So 1 GBP is equal to 1.52031 USD. If you use one lot size, that means you're using 100,000 notional value of GBP. So if it goes in your favor, the price, what you're going to get in, you're going to use USD to purchase this is 152,031 US dollar to purchase 100,000 GBP. So a price moves now, pay attention. A price moves now from 1.52041. It means that price has moved and used one lot size. Now, what you're going to do, if it moves from 1.52041 to 1.52031, assuming that you sold it, price moved from 1.52041, went down to 1.52031. That means if you sold it, means it went down, okay? And the price went down from 1.52041 to 1.52031. What it means that if you use one lot size, okay, 100,000 notional value of GBP will be equal to 152,041 notional value. So if it moves from this to, which that's if you're selling, or if you're buying and it moves from this to this, your profit will now be because you're multiplying now, right? So you're multiplying 100,000 by this. You're also multiplying 100,000 by this. So if you bought and you move from this to this, that means if you subtract this, the first one from the second one, 152,031 from 152,041, you're going to get only 10 USD, $10. That is now your profit. I'll take it again. Pay attention. We're using two figures now, two prices. First price is 1.52031. Second price is 1.52041. Now, I told you that this 1.52041 is the value of the dollar. And then the value of the GBP is just 1. So you're using this to buy one of these. Now, if you use one lot size, it means that it's 100,000 of this to give you, if you times 100,000 by this, you also get this. Now, it then moved from this price to this price. Still do the same multiplication. Since it's still one lot size, 100,000, and then 100,000 times this one, we have this one. If you subtract the difference, 152,041 minus 152,043, you're going to get 10. That is why we said that one lot size, which is 100,000 notional value, is $10 per pip. Because what it moves here, what moved here was just 1 pip from 3 to 1. Remember, by using the fourth digit, it moved from 3 to 4. So it has moved by just 1 pip, which is 10 points. 10 points is 1 pip. Who does that before? So just 1 pip. That's how we got $10. Assuming that you use 0.1 lot. 0.1 lot is 10,000 notional value. So if you multiply 10,000 by 1, you get 10,000 GBP. You multiply 10,000 by 1.52031, you're going to get 15,203.1, okay? And then here will be 15,204.1. So if you minus it, you're going to get 1, 3, and 1, 4, and 4. That's 4 minus 3. You're going to get only $1. Using what? 0.1 lots. You get $1. Then if you use 0.01 lots, here will now be 1,000, and here will now be 1,520.31. Here now be 1,520.41. So if you minus it, you're going to get $0.1, which is 10 cents. That is how profits are calculated. That is how profits are calculated. If this is clear, type clear. If it's not clear, type not clear. If it's clear, type clear. If it's not clear, type not clear. Paulo, thank you. Clear. Chijoke, clear. Thank you. Shalom, clear. Clear. Okay, good. Apoveri, clear. Harrison, clear. Okay, perfect. Okay, thank you very much. Okay, let's proceed to the next one. I'm glad you understood this. Let's go to the next one. Now, the next thing you need to learn is called leverage. The next thing you need to learn is leverage. Now, having understood all that we've learned, then leverage will be easy for you to understand. What is leverage? It is a way for traders to borrow capital to gain a larger exposure to the financial market. What do I mean by that? By rights, if you want to trade Forex and buy GBP USD, you will need at least 100, you need at least for you to make $1, for you to make $1 for every move, you would need $10,000 without any form of leverage. And if it moves in your favor, you make $1 profit. If it moves against you, you lose $1 loss. You lose $1. Then, if you want to make you want to make 10 cents, you will need at least $1,000 to trade the financial market. But today, traders can trade with as low as $100, as low as $10 to trade the financial market, even if I don't advise $10. But people do that. Why can you trade the financial market with less capital and yet gain more. It is the instrument of what we call leverage. So the mechanism to be able to trade large position, all right, with low capital, with small capital, is called leverage, meaning that the brokerage firm, the broker, the platform where you're trading the forex, that the owners of the platform, the broker, gave you access, borrowed you money, so to speak, gave you access to trade larger position size with less money that you brought in. So you hear terms like 1:10, 1:100, 1:1,000, 1:500 leverage. You hear leverages like that, meaning that if you have 1,000 and if it's 1:10, you can trade what a $10,000 person is trading and get that same profit or that same loss that the person will get. That's 1:10, meaning that your $1,000 is seen as $10,000 if the leverage is 1:10. Then if the leverage is 1:100, that's your $1,000 that you brought as capital is seen as $100,000. So it's as though you're trading with $100,000 capital, whereas you brought only $1,000. That is leverage. That's power of leverage. So the broker gives you access to trade more positions with less capital. Okay, that's leverage. So you can see leverage of 1 to 500, meaning that if you come with a $1,000 account, you can trade $50,000 account size. That's what it means. So when you're trading with a $1,000 account with leverage of 1:500, the market is seeing you as though you're using $50,000 to trade it. That's what it means. That's just what it means. Okay, so that's the power of leverage. But everything that has advantage also has what? Disadvantage. So if you go for higher leverage, just also know that if you lose, you will lose more. That's if you gain, you gain more. If you lose, you also lose more. That's the disadvantage. So you either make more or you lose more when you have higher leverage. If you have lower leverage, you make less. You also lose what? Less. So that's just it. So platforms differ, and a lot of platforms can give you several leveraging. Some can be 1:10, 1:30, 1:50, 1:100, 1:200, 1:500, 1:1,000 leverage. So it depends on you if you want to trade higher leverage or lesser leverage. So I said this could lead to more profit or losses. Okay, so it's like you have $500 as a deposit, and then if the leverage is 1:100, as if you are trading $50,000. That's like what it means. Because if you multiply 500 by 100, you're getting 50,000. So that's what this whole thing means. So leveraging. So if you bring in 1,000 and the leverage is 1:100, it means that you're trading $100,000 position. That's how the capital that they are seeing in the market. But you just brought a $1,000 account. I guess this is very clear. There's no need to ask if it's clear because it's actually clear. Okay, we have the next one called margin. Margin. Now, margin. All right, pay attention, please. Pay attention. Margin. If you come to trade the financial market and you have a leverage of 1:100 and you're having a $1,000 account, okay? And then they are seeing you as though you're trading 100,000. So you're occupying your leverage is 1:100. So the market is seeing you as though you're using 100,000 to trade the market. So if you start losing, let's say you lose up to what do you call it? Lose up to $10,000 from that $100,000. It means that normally on your listing, it has reduced from your trading account has reduced from $1,000 to $100. So at that point now, your margin is dropping. So if you then lose from the 10,000 back again to 1,000, meaning that normally you have lost from 100,000 back to $10, $100 back to $10, your margin will not be low. Once your margin is low, there's what we call margin call. The broker will call you, or rather, the broker will give you, there will be a notification. That notification is called margin call, that your account is now lower than the expected leverage, and that the position you're in, you can no longer, the trade can no longer carry your position because you've lost so much. So that's what we call margin call. So the margin is the difference between the amount they gave as your leverage and the amount you brought in as capital. That's the difference. So here you have notional value divided by leverage. So an amount of money required to keep trade open. It is not a transaction cost, just an amount set aside as a good faith deposit. So every trade must have a margin required to actually sustain that trade based on the leverage and based on the lot size you are using. So let's say, for instance, you have a $1,000 account and you want to use leverage of what do you call it? You want to use the notional value of 1 million. That's 10 lot size. Okay. Now the trade might allow you, but once you start losing, there'll be a margin call, because that's what they call it, position you choose in the market is way higher than the leverage given to you. That's what it means. So you know notional value 100,000, 10,000, and the least is 1,000. So if once you divide your notional value by the leverage you use that they gave to you, you will now know your margin. You now know how much that is required for every transaction you take in the market. That's what it means. So let's say, for instance, you have a $1,000 account, and then they give you a leverage of 1:100. And then the notional value of that asset is the notional value, that's the lot size you use. You want to purchase 100,000 at notional value. So 100,000 divided by 100,000. That means you need at least $1 should be left in your trading account for you to trade that this position. But if you divide 100,000 by 100, you get 1. So if you lose up to the point where is going up less than $1, there'll be a margin call. But if the leverage is 1:10, for instance, it means that you can only operate $10,000 accounts. That's your leverage. And then you use 100,000 notional value. It means that once the trade starts getting to 0.1, which is 10 cents, the margin call will come. So it differs. And then you cannot trade more leverage. You cannot trade using more lot size, per position. That's how it is. Now, all these things that I'm saying, you don't need to start calculating them when you are ready to trade. The technology has brought in a lot of ease to humanity. So there are softwares, there are apps that we can use for our phone or our laptop that can help you calculate all these things. So all you need to do is just to put your, what they call it, we call it, like for Android phones and even iPhones, they call it Forex Calculator. You download the Forex Calculator app, and then you type in how much you want to trade, how much is in your account, your stop loss, and the amount you want to raise per percentage of your account, everything. And then to tell you the lot size you will use. Based on that, you don't need to start calculating it, but you just need to understand or know what they are, so that if you're asked to explain, you can explain it. So the amount required, the amount of money required to keep a trade open, that's what we call margin. How did they calculate it? The notional value divided by the leverage that you're given. That is it. So if you're giving leverage of 1:1,000 and you wish to trade Euro USD with volume lot size of 1, which is 100,000 euro, instead of having to provide the full 100,000 euro, you would need just 1 divided by 1,000 times this amount, which is what 100 euros. So if you have 100 euro, you can trade it. So your margin in this case now is just what 100 million. That's what they are trying to say. Note, if your account is in dollar or pound, it would further convert the currency into your what account. So basically, that's just what it is. So to calculate what they call margin is just notional value divided by what leverage, and the explanation is all else. It's just the money required to keep a trade open at every given time. All right. Next one is okay. Now equity. There's one between account balance and equity. Now, account balance, let's say you have $1,000 account. You open the $1,000 account. That deposit you made is your capital. Once you enter a trade and you lose, let's say you entered a trade, $1,000 account, and you lost $10, your new account balance will now be $990. That's account balance. Then equity is the amount you have that is still running, that is not closed yet. Let's say, for instance, you have a $1,000 account, and then you place a trade, and the trade is on. The trade has already made $10 profit or $100 profit. So if it's $100 profit, that means that your equity is 1,100, but your balance is still $1,000 until you close the trade. If you close the trade at $1,000, $1,100 equity, then your balance will now be changed to $1,100 balance. But if you don't close the trade, as long as the trade is not closed, your balance, your account balance and your equity balance will be different. The moment you close your trade, then your equity balance and your account balance will not be the same. So sometimes your account balance can be $1,000 and your equity balance can be $1,980. As long as you've not closed the trade, it is not balanced yet. It's not your account balance, it's still equity. When you then close the trade, if you finally close the trade in profit, whatever amount you close the trade on, that is what the balance will then reflect to. So once you close the trade, your balance will now be updated. So the difference between equity and account balance is what is already there when you open the trade. Then when the trade is running, the balance that you have there is your equity balance. The account balance is still different from equity until the trade is closed. So at the point when you're trading, that once the position is on, you have what we call equity balance, which may be different from your account balance. The moment you close the trade, then your account balance and your equity balance will not become the same. Is that okay? That is it. Then we have what we call free margin. Free margin, we've already talked about margin before. So free margin is equity minus margin. That is free margin. So let's say if your equity is lower than your balance, and then if you minus it from the margin, give it as the minimum amount required to keep a trade open. Once you minus it, if it is high, that difference is called free margin. If it is low, that means you'll start calling that, look, this thing is low, you need to add money, or they will terminate some brokers will just cut the trade off because you're not below your margin call, your margin that they gave to you. So they'll close the trade. So free margin is equity minus margin. The margin level, equity divided by margin. That all these things, you don't need them anymore, you just need to understand them. That's all. You just know that these things are there so that when they ask you questions, you can just answer, I know what margins, I know what equities, I know what leverage is, I know what lots is, I know what PIP is. You know, you just need to know the terms. So that's just it. Okay, so I think I'm done. Time for questions. We have 12 minutes for question and answer, and then we'll call it a day. We spent 1 hour, 48 minutes already. Okay, so question time. Question time. Type your question. I'm ready to take your question. Type your question. I'm ready to take your question. Question, question, question. Question, question, question. If there's no question and the lesson is well understood, you can type something, say something. Okay, equity is not clear. equity is not good. Good news. Goodness said equity is not clear. Once you place a trade, once you place a trade, either buy or sell, as the trade is moving in your direction, in your favor, the balance you'll be seeing will be called equity balance. It will only remain like that until the trade is closed, either in your favor or against you. So when trade is on, you will have two balances, the account balance and the equity balance. The moment the trade ends, then the two balances will not agree. They will not have the same thing. So equity balance is just when trade is on, while account balance is the initial balance you had before you placed a trade. That's the difference. Okay, that's the difference. How do we calculate the margin, please? How do we calculate the margin? Like I said, we have forex calculators that will tell you how to do all those, but I told you that to calculate it is your notional value divided by your leverage. That is how you calculate margin. But you don't need to bother yourself with how to calculate it. We have calculators that can do all those for when you want to trade, when you start trading. Okay? Give us the recording because some of us, okay, we will do that. Are we going to have the full recording sent here on this platform? Yes, I will do that. I'll send the Zoom link and then you watch it via the Zoom link. That's why I told us from the onset to you can record it from your end, you can record it from your end. But of course, I'm going to send the recording once we are done. Those of you on the Zoom app, no one is asking question. Is it that we understood perfectly well? Is it that we understood perfectly well? No question. I'm not seeing any question. When is our next class? Our next class is Friday. Next tomorrow is our next class. Our next class is Friday. We'll have our next class on Friday. What's the next question? When you play stop loss, how do you know how much will be your profit? There is a calculator for that as well. Okay. Once you use the forex calculator, it will tell you how much you are risking. Okay, so you don't have problem with that. I think you will still emphasize on the margin next time. Okay, okay. I don't know what you want to understand with the margin. I just explained that to you, that it is the minimum amount required to place a trade and let that trade be running. Let it be open. That's just what leverage, what do you call it, margin is. But once you listen to the recording, maybe you understand it. But I know that these terms are new to you guys, so it's understandable. Okay. Okay, sir, may I ask whether we are going to be reimbursed for this type of busy at the end of the day? What do you mean by that? Hey, Shuni, what do you mean by that? I don't even understand. Reimbursed, how do you mean by reimbursed? With stop loss limit your profit level of it. I don't understand. Samuel, maybe you should rephrase your question. Samuel, rephrase your question. It's not clear. On Friday, by what time? 8 p.m. Our time is usually 8 p.m. 8 p.m., 8 to 10 or 8 to 9. By 10, we should be done. At most 10, we should be done. I don't want to keep us more than 2 hours. Okay, I think we are done. No other questions so far. And this is 9:52. I want to thank you very much for is stop loss compulsory in trading. Absolutely, 100% compulsory. No matter how good you are in trading, you must play stop loss. You must play stop loss, and I'll tell us why later. You must play stop loss. Okay, so that being said, there's no further question. We'll call it a day or a night. Have a wonderful night rest. See you guys on Friday. Our Friday topic will be the trading platform. That's what we look at, trading platform. So if you enjoyed today's lesson, please give me thumbs up. Say some nice things. Let me be encouraged that I'm doing well as well. Please, I need to encourage me. Thank you. Will we be giving money for the business? How do you mean? This thing is free and I'm teaching you for free. I didn't ask you to pay me money. This is free class, all right? This basic course is for free. Okay. Thank you, thank you, thank you, thank you, thank you. All right, all right, thank you. Thank you very much. See you guys on Friday. Have a lovely night rest. Bye now.